Our next guest says the worst for the markets is still to come. Here to tell us what to expect and why is David Levy. David is chairman of the Jerome Levy Forecasting Center, and he brings with him more than 30 years of professional forecasting experience to the table. David, good to have you back with us.
Good to be here, Carol.
So the worst is still yet to come. Why and how bad does it get?
Well, first let me make it clear that I'm not saying necessarily we don't have some more upside in the stock market in weeks or months ahead first. But basic issue is this. We have an economy that is going to be dealing with deflation, not inflation, dealing with continued high unemployment, dealing with balance sheet contraction, not only in the financial sector, which more people are aware of now, but in the household sector and in the non-financial business sector. And what this means, the economy is just simply not going to be able to be jump-startable. We'll push it with the federal government a bit, but it's going to lurch forward. And during that period, we're going to see movement away from risk, and I think we're going to see some more declines in stock markets and home prices.
That whole idea of deleveraging, meaning that we're not done, we're not even close.
Well, it depends what you look at. If you look at asset prices, a lot of them have maybe made half the declines they need to make. But if you look on the debt side, we've barely scratched the surface. Maybe 1 or 2% of private debt that has come off in the last 3-4 quarters.
Nonetheless, you see some good numbers coming out. Even the most bearish of the bears are now saying we see some good employment numbers coming out the next couple months. Corporate profits are going to look good in the first half. Is it a head fake? I mean, do you think we'll see the market continue to come up, and then people will be fooled as sort of the floor falls out after that?
I think likely we're seeing somewhat of a head fake with profits. I'm not even sure how good the fake will be with employment, because while we may flirt with some positive numbers, there is a little bit of inventory-related people coming back, and some more. But we're still seeing signs of a very, very weak labor market.
The inventory increase, though, you expect pretty much done now. It's pretty much been played out.
I think it will have played out by the time we get through the first quarter. Maybe it may overshoot and go a little further in the second quarter. Remember, the numbers we're looking at, their most recent, are still January numbers. So when we don't really have the first quarter data yet.
Go back to the labor data, though, David. I mean, you anticipate, so maybe it ggets better and then it gets worse, what, in the second half of this year?
Yeah,
are you saying that we maybe see some job creation, then we go back to losing jobs?
Well, I think generally speaking, I think that's likely. The momentum that we're picking up is largely tied to the inventory bounce and some pent-up spending by businesses who were just afraid to make routine replacement outlays during the crisis period, and consumers who had a similar reaction, who had their jobs, but just were scared to death, and they didn't replace that washing machine, and now it's completely dead, and they're finally doing it. So I think we're getting a bit of a spurt, but I think these things are going to fade as we go further into the year because of overcapacity, lack of a real desire to build, and a need in the household sector to actually spend less of incomes.
So, but the main problem, I mean, why we can't go from a government-fueled recovery to a self-sustaining recovery, you think is really the big debt overhang?
The debt and it ties in with the asset size, because if the assets are worth a lot, the debt is fine, at least in the financiers' eyes. I mean, basically, there's one little fact that almost no one knows, but it's very basic. An economy cannot generate profits without balance sheets expanding. The only reason we have any and a substantial amount of profits right now is while the household sector and business sector's balance sheets are contracting, the government is expanding its balance sheet and dumping a whole lot of wealth into the economy in the form of its own IOUs.
There is a silver lining, at least according to, I think, what you're saying. You say the bright side to the sustained period of economic woes is that it will clean things up. So eventually, ultimately, things do get better. And how long does it take?
Well, I think, unfortunately, I think this is kind of a multi-business cycle, multi-year process, something on the order of a decade. Now, that means to really get things cleaned up, we could have some counter moves along the way. But this is really, I mean, compared to the alternative, which is a complete collapse, which is not hard to imagine. What if we hadn't stabilized the financial system? What if we didn't have all this stimulus? Right. We'd be worse in the 30s now. So it's better to muddle through, and there are going to be some great opportunities for businesses and investors coming out, I don't think yet, but maybe in the next 2-3 years, and after that, for great long-term investments.
Okay. But we got to be cautious in the meantime.
I think this is too early. Yeah, right. Be careful.
It's not a very silver lining.
Unless you're a trader.
It's barely a silver lining.
Yeah, but I'm very bullish about the long run. I really think our grandchildren are going to prosper.
We got to run. All right, everybody. David Levy.